Joining us on the phone this morning, Vice Chairman of Blackstone's Private Wealth Solutions Group, Byron Wien. Byron, it's great to talk to you this morning.
Always good to be with you, Carl.
Is this action in equities today reflecting the weak ISM, the weak construction spending, hopes that, in fact, this is not going to be one and done?
No. Well, my feeling is it is going to be one and done. My position, I think I stated on the program earlier, is the Fed shouldn't reduce rates. The economy is doing well, and the mandate of the Fed is clear. It's responsible for keeping employment full, and we have full employment, and for keeping inflation low, and we have low inflation. So there was no reason for the Fed to cut rates, and they did, and the market reaction yesterday was a mistake. Powell did the right thing by doing as little as possible, and the market woke up to that today, and that's why it's erasing the loss from yesterday.
I wonder what your take is on the 10-year. If we're just a stone's throw from taking out the lowest yield, really, since Trump took office.
Yeah, I mean, my feeling is that the 10-year is the yield is too low, and the reason for it is all the liquidity that's been produced around the world in the last decade. In 2008, the combined balance sheets of the major central banks was $3 trillion. It's $16 trillion now. And a lot of that liquidity is looking for a place to hide. And what better place to hide than the 10-year Treasury? And so it is the demand for protection that is causing the 10-year yield to drop below 2%.
So you don't think the bond market is signaling something that, for example, the equity market has been slow to catch on to this idea that maybe global growth is slowing and there's reasons to be concerned?
I mean, no, I really think it's the liquidity that's driving rates low. I do know that they're slowing, aware that they're slowing around the world, but the U.S. economy is still okay. And I think we're not going to have a recession until 2021 at the earliest.
Byron, in light of the fact that we're doing better here than the rest of the world, what do you make of the argument that's been circulating out there that we have to cut because other countries are cutting?
I don't think it's a race to the bottom. I think that's poor economic thinking. I think we should do what's right for our economy, and we shouldn't take an action that reflects monetary policy or economic behavior around the world.
Byron, we've had a couple nights of debates on the Dem side. Some commenting today that there's really been no one who demonstrating that they could be a Trump slayer, in the words of Fundstrat today. At what point does policy risk from the election really start to creep into equities?
I think it already has, Carl. My view is that Trump, I think you're right, there isn't a Trump slayer out there, and so the market assumes that Trump is going to have a second term. The market believes that Trump is good for the market. The market also believes that a Democratic victory would convert Washington from business-friendly, business-unfriendly, and that would be negative. So if there were a Trump slayer out there, or particularly if any of the three progressives were to emerge as a prominent candidate, and if one of them would win, I think the market would interpret that negatively.